Hello, my name is Michael Lenox. I'm a professor here at the Darden School of Business, and I'm also the executive director of the Batten Institute for Entrepreneurship and Innovation, a research center here at Darden that is dedicated to advancing our thought on how entrepreneurship and innovation could address issues around the social good for the better. Today I'd like to discuss with you some area of research of my own around green technology, or sometimes called clean tech, entrepreneurship and innovation. This fits into one of our broader initiatives at the Batten Institute around sustainability and innovation. Other initiatives we have at the Institute include an initiative around healthcare innovation, emerging markets and entrepreneurship, as well as innovating for organic growth. The focus of my comments today are to think about the green technology industry, and in particular, what are the drivers for the boom we have seen investing in green technology. I'll also take some time at the end to talk about some new research that I'm pursuing looking at these drivers, and in particular looking at the role that public policy and private strategies play in driving entrepreneurship and innovation in green technology. Anecdotally, there has been massive growth in interest in green technology over the past 2 years. Renewable energy sector, for example, solar, wind, biofuels, have seen substantial increases in investment over the past 2 years. We've seen in the auto industry increased interest in alternative engine technologies such as hybrid, electric, and hydrogen fuel cell technologies. In sectors as diverse as retail, chemicals, information technology, we're seeing a lot of ferment around the potential for green technologies to basically transform different industries and different markets. So an obvious question is, what is driving these? While clearly the current recession has dampened some of the enthusiasm for green technology, it continues to be a broad class that grows. In 2008, while the rest of the venture capital market shrunk by about 8%, we saw that the green tech space grew by about 50%. In total, there were 277 deals completed for about $4 billion worth of investment. This represented about 15% of the total venture capital invested in 2008. Not surprisingly, in Q4 and Q1 of 2009, we've seen a substantial drop-off in all venture capital investment, including green technology. But in Q2 of 2009, we've seen an actual rebound, about a 73% increase in green technology investment in the last quarter. Just today, Khosla Ventures announced the introduction of a new $1.1 billion fund for investing in green technologies. So what in part is fueling this interest? One can imagine a number of economic drivers for green technology. First, and perhaps most obvious, be consumer preferences. Consumers might be willing to pay a premium for green technologies. We see in the auto sector, for example, that hybrid vehicles sell for a premium of a few $1,000s over their non-hybrid equivalents. In the U.S. Electric utility market, we now have many electric utilities providing an opportunity for consumers to pay a premium for buying green power, renewable power and energy. And in a number of different sectors, businesses are adopting green technologies as a way to burnish their brands, improve their standing with consumers, and ultimately increase demand for their products and services. These can help not only with consumers, but also help perhaps inoculate the firm or make them less likely to be a target of environmental activist actions, which can also be damaging to the brand and the reputation of the firm. Now, historically, consumer preferences for green goods has waxed and waned as public sentiment and interest in environmental issues have shifted over time. It's an interesting and curious question of whether or not in the current economic recession, whether demand for green products and technologies will persist. While I don't think we have definitively the answer to that right now, I think we can say, at least anecdotally, that in this latest upswing of interest, the demand and interest has been more sustained and of greater depth than we have seen in other previous upticks. I think looking forward, I think it's safe to say as the economy turns around that we'll probably see an uptick once again in interest amongst consumers for paying premiums for green goods and services. A second driver I'd like to discuss today is operational efficiency. Businesses and individuals might be pursuing and purchasing green technologies simply as a way to improve efficiency. The most obvious example would be lowering energy costs. When it comes to, for example, installing energy efficient lighting or adopting efficient heating and air conditioning units, these are just but two examples of ways in which firms are looking to adopt green technologies to lower their cost structure. Now, when it comes to things such as renewable energy, such as solar, wind, biofuels, and the like, clearly part of the economic viability of these technologies is really dependent on the prices of traditional fuel sources, fossil fuel sources, such as oil and coal. Oil in particular, as I'm sure many of you are aware, has been quite volatile in the last year. About a year ago, oil prices on the global markets peaked at around $150 per barrel. It then bottomed out a few months later at about $30 per barrel, and now has risen to about $70 per barrel of oil. Clearly, this volatility affects, once again, the viability of these alternative energy sources such as solar and wind. I think it's safe to say that this volatility increases the risk associated with investment in green technologies, and as a consequence raises the thresholds or raises the expected values needed to be generated out of these technologies to make them worthwhile investments. The third area I'd like to talk about is government subsidies. Government subsidies in a number of industries, especially renewable energy, have been a big driver historically for these green tech investments. These subsidies may take any number of forms: tax subsidies, subsidies for R&D for renewable energy, and the like. The government can also subsidize green technologies through their procurement function. A very large purchaser, they can require that products and services have some type of green technology or green bent to them, and this can also drive some of the demand for green products and some of the drivers for incentives for green products. In terms of these incentives, it clearly seems in some cases, in particular wind and solar, that without these subsidies, some of these industries might not seem viable. And clearly, some of these industries seem to hang on whether Congress reapproves subsidies in these areas or not. The subsidies at the end of the day are really interacting with these other types of incentives, once again the price of oil or coal or other alternatives, and determining the viability of these different technologies economically. Just recently there was a nice article talking about how, for example, subsidies at a state level for solar energy have been decreasing, been pulled back in by a number of states, yet simultaneously we've seen an increase in supply in solar technology that have driven prices down in solar. So once again, it's a more complicated story than just simply saying government subsidies exist and that's what drives the market or not. One could imagine with the current federal stimulus monies, many of which have not formally been released for green technologies and the like, that we're going to see in the short run an increase in these drivers for green technologies. It's just but one example, the recent Cash for Clunkers program in the U.S., while not particularly dedicated towards hybrid and alternative vehicle engines, clearly helped increase demand for those vehicles. The fourth area I'd like to talk about related to government subsidies is government regulation. Government might directly, in many ways, force green technologies or drive green technologies to be viable. In the U.S. auto industry, we have rising CAFE standards, which are going to require and drive auto companies to increase the fuel efficiency of their vehicles, leading to perhaps alternative technologies like hybrid and electric. In the electric utility sector, we see the potential for, and actually more broadly, the potential for a cap and trade system in global greenhouse gas emissions in the U.S. This could be actually a very, very substantial, significant driver of green technologies in the U.S. Estimates suggest that if we have, for example, a $30 per ton of CO2 equivalent permitting fee, that this will really change the dynamics of this industry quite drastically. Now, while it's not clear whether we will see a cap and trade system or even a tax subsidy or tax increase on greenhouse gas emissions in the U.S., I think the odds are significant enough that for any investors, for example, they need to be factoring in their expectations of such legislation in their estimates of the viability of different green technologies. Finally, I'd like to talk about strategic positioning. For the past 10 years, I've been teaching and studying strategy. And one of the things we know is that when we have a technology disruption within an industry, that this often leads to a disruption in the competitive order as well. New technologies, like we're seeing emerging in a number of green domains, often lead to niche opportunities. These niche opportunities open the door for entrepreneurs, other smaller firms to move in to what might be competitive markets dominated by larger players. Innovation might lead some of these players to grow and flourish, and in many cases they might supplant many of the existing dominant players within a given industry segment. It's not always clear that the firms who are currently the dominant players within the industry are going to be the ones who are going to survive and thrive as the technology shifts. Take the petroleum industry, for example. It's not clear whether a BP or an Exxon are going to be the ones best positioned to benefit as technology switches to, for example, wind or solar. While clearly they're going to be profitable firms for the foreseeable future, once again, it's not clear that they're going to be the market leaders in these new technologies. Similarly, if we look at the auto industry, I believe, and perhaps this isn't so radical a projection given the state of the U.S. auto market, but that we'll probably see an emergent auto company within the next 10, 15 years that you and I don't even know the name of at this point. The invariable two guys in a garage are going to come up with something new that might revolutionize the industry. Once again, we've seen in industry after industry before that when we have a change in the core technology, that it often leads to entrepreneurial entry and a competitive disruption within those industries. So I think it's this last driver that in part is really motivating a lot of the activity that we see in the green technology space, especially from the more entrepreneurial sides of the investment community. And it's with this in mind that I have undertaken this recent research project trying to understand the drivers of green innovation and green entrepreneurship. I'm working with Mary Margaret Frank, one of our professors of accounting here at Darden, as well as with Jeff York, a doctoral graduate of Darden, who is also spending a year as a research fellow at the Batten Institute. We are collecting data from a number of different sources, trying to characterize and get our hands around where innovation is happening in the green technology, clean technology space. For one example, we are looking at patenting levels and seeing where green patenting activity is taking place. With these data in hand, we're asking a number of what I think are important critical questions moving forward. First, are entrepreneurs or established firms more likely to pioneer various green technologies? For one example, we are collecting data looking at entry into the green building supply industry. This includes everything from green toilets to green roof tile and the like. Now, anecdotally, looking at the evidence we've collected so far, it seems that the primary, at least initial entrants into these segments are actually new ventures, not established companies reconfiguring their goods and services to satisfy the green market. What does this mean for policy? Well, it can mean that, and for policy, that we should be encouraging more entrepreneurial efforts rather than maybe subsidizing larger established companies. Perhaps we'll mention, $40 billion bailout of General Motors. Was that the best use of money if one of the goals, primary goals, was to transform the auto industry into a more green alternative vehicle technology industry? Or perhaps that $40 billion could have been used to invest in a whole host of new ventures that are out there, to establish a venture fund or to subsidize basic R&D. Second question we're asking are, how are firms positioning themselves in these emerging markets? Are they competing on intellectual capital and intellectual property, or are they competing on other domains such as capabilities in sales and marketing? Once again, these are important questions for understanding how these industries will evolve and unfold, and I think have implications for public policy as well. In our preliminary work that we've done this summer looking at solar and wind, it's been very interesting to see how different firms are positioning themselves strategically within those industries. The argument has been made by some that, for example, in solar, that much of the patenting activity that has taken place there has been done in the past and is now for the general public, general consumption. And as a result, that the real competitive position within the industry is not in innovating around the core technology per se, but innovating in ways in which you can leverage that technology to scale it up and use it in different settings. So for one example, if you look at General Electric not necessarily is spending a lot on innovating the core technology around wind. Rather, they're spending their efforts innovating around how you connect a large selection of windmills together in a network, and then how you then power that up to the grid. So once again, there's really interesting questions about where the different positions are for firms to play in this market, whether or not this is going to lead to entrepreneurial firms being the ones to dominate, or whether we might see established players who have complementary capabilities in things like manufacturing and sales that might end up being the dominant players. And this relates to the final question we have, which is, what role does public policy play in shaping these markets and driving them forward? In particular, we're looking at tax subsidies as but one policy mechanism. In the United States, we have governors from throughout the states who are basically arguing that if you increase the tax subsidies for renewable energy, that this will lead to green innovation and entrepreneurship within their states, lead to a green economy. I must admit I'm a little skeptical whether a subsidy for renewable energy in Virginia, for example, will then create the next Silicon Valley here in the state of Virginia as well. It might very well be that those subsidies then lead to innovation and entrepreneurship in Silicon Valley, or maybe perhaps China. And what does this mean for public policy? So it's these answers to these types of questions, once again, that have important questions and important implications for the structure of U.S. policy. So while I wish I had answers to these questions for you today, I do encourage you to keep track of the work that we're doing. Please refer to the Batten Institute website at batteninstitute.org for updates. I'll end by observing that while there may be a tendency among some to view the green tech economy as a fad, perhaps something that's going to disappear in the next year or so, I believe that the underlying concerns that are driving much of what we're seeing in the green technology space aren't going to go away anytime soon. We're not going to solve problems such as global climate change within the next year or the next 10 years for that matter. So the underlying pressures that are leading to policy shifts in public sentiment and the like that are fueling the drive for green technology, I believe aren't going away. And as a result, I think this is going to be a robust area for entrepreneurship and innovation for the foreseeable future. Thank you very much.